call the meeting to order. And do we need to make any changes to the agenda?
No, but I would say that the vested terminated item, Bob's going to speak to that when he gives his presentation.
Okay.
I don't know if we really need to change the agenda for that, though.
All right.
Does Bob need to be somewhere?
He does.
Yeah, as always, Bob needs to go to the airport.
So,
Bob gets to go first.
Yeah, I'm actually in a hotel room now. I'm getting ready to move from city A to city B.
so can I move that we just change the order to put Mr. Klausner first, the board attorney?
He is first.
Is it?
Well,
All right, after we approve the minutes from last meeting.
I'll approve, or
Yeah.
motion to approve.
Motion to approve, second?
It's not first.
Listen,
Oh, it's not
You
first?
just said,
we always believe what we're told.
The board attorney presentation is first, and he can speak to that item when he does his presentation.
Do I have the wrong agenda then? For May 23rd?
The board attorney update?
I don't read is what you're telling me. Nobody reads, all right?
It's usually good.
Steven, it's not getting any better, I can tell you that.
all right, there's a motion to adopt the minutes from last month, or last meeting. Is there a second? All right, Harvey seconds.
Second.
All in favor?
Aye.
Opposed? Okay, so we'll move on to the board attorney update. It's on you, Bob.
Thank you. Good morning, Paul.
Good morning.
Good morning.
Couple of things that I wanted to touch on. The first is House Bill 3, which we have discussed in pieces, did pass, did sign, and becomes effective July 1. Does not affect any investments that we have in place, but it effectively says that all investments made on or after July 1 will be affected. And it's it says you're not supposed to use social, or political constructs to make your investment decisions, which in the 10 years that I've been with you, you've never done. So I don't think that part of the bill is going to affect. You've always invested the highest and best return at a reasonable rate of risk. And I think that's not going to change. The biggest change is there's going to be very specific rules about proxy voting. You're going to have to say every issue you voted on, why you voted on it, and if it is a shareholder message or shareholder proposal that is not specifically geared towards the pecuniary aspects, financial aspects of the investment, you have to vote no. And we're supposed to do a report to the Division of Retirement in December, and every 2 years after that, in a form dictated by the Division of Retirement, which is now going to have to engage in rulemaking, which, under the provisions of the State Administrative Procedures Act, Chapter 120, the Florida statutes, there is not enough time between now and the end of the year to get ruling. But that said, that's the legislature making these changes. The bill, House Bill 3 is like 16 other similar bills that were passed around the country that were intended to reject any decision-making using environmental, social, governance issues as the bases. In other words, advancing some agenda other than economic welfare of the system. So I think it was more a political statement than anything else. The proxy voting, we'll have to see what rules they come up with. But we have a memorandum which is going to be coming out either the end of this week or right after Memorial Day, that goes over the bill in detail and makes some suggestions. There's going to have to be some language in future investment agreements, future custodial agreements. Like I said, it doesn't affect any agreement currently place, or renewal of an agreement in place, but new contracts would have to have some kind of disclaimer about, we're just gonna vote on the money in that sense. So I would stay tuned for that story.
Bob, I'd mention also that our investment consultant on the general pension plan, ANCO, has indicated that they are actually working directly with the Division of Retirement to craft the rules that are going to apply.
We've been in touch with them also, but the fact that we help them doesn't mean they listen.
Right.
So we'll see. Like I said, we'll see how that plays out. I was asked another question about a spousal benefit for a vested terminated member who passed prior to reaching retirement. The question is, could the surviving spouse, who was designated as the beneficiary, elect a survivorship component? The member didn't elect anything. He didn't name a beneficiary, but he didn't pick an option. And the default option in our plan, a 10-year certain in life thereafter, which would mean just 120 pension payments, and then that would be the end. And I did provide written guidance to the pension staff on the issue. William, has that been distributed to the board?
It has, and I also have it up on the screen. You probably can't see, but we're looking at it right now. And they also received it in an email.
Yeah, no, all I'm seeing on the screen is the agenda. But that's fine, I have it. Go with it. But basically the right to select an option is a property right. And property rights are inheritable. And in this particular case, a benefit election would have to be made at least 3 months prior to the date of benefit commencement. Now, this particular member died last year, and so at the time he passed, that having not made an election, that election right was inherited by his spouse, and as long as she elected it within 3 months of being told to make an election, then that would be fine. So in other words, her election would have remained active. Her ability to select remained active until April 1st. And so I think it's too late for the short answer, but the surviving spouse has the right to elect 100% joint survivor, standing in the shoes of the member, and that would give her a lifetime benefit. I did cite cases to you where the Florida courts have permitted similar elections in the past because spousal rights would have vested when the member was vested. That's also been the case in other states. One in Maryland, where in that case they allowed the union as the representative, as the helper for the family, to make this election. And a similar event in New Jersey involved the inherited right to make a survivorship election. Yep, that's it. So Florida courts have said since the 50s that, and most recently in 2013, that pension rights are supposed to be liberally construed and taken up. So what would happen here is, if the surviving spouse wants a lifetime benefit, she may elect the joint survivor benefit. Now, that'll be a lower monthly payment than the 10-year certain, but it won't just end at 120 payments. It will continue for life. Now, if she elects that and she were to pass, as long as she has received payments equal to the member's contributions, that would be the end of the benefit. Whereas in a 10-year certain case, where members or person receiving from the member hasn't yet received the 120 payments, the balance of that would inure to the estate. But in this case, I assume she's going to choose a lifetime for obvious reasons. So happy to answer the question.
Does the board need to make a motion and approve it to allow this, or is it just, do you
I think this is my opinion about what the staff can do
Okay.
differently. Where you don't want to allow it, then a motion would be in order. If not, this is just my view of the operation of the provisions in the plan. And it's 2-600 A, 2-601 of the code. So you would just, as staff, as that has been delegated that authority. So it might be no action.
So, Bob, I have a question. if you don't mind.
Yes.
It's a change of annuity that requires a 90-day. Can the board waive the 90-day?
It says I think you could, because you have some extenuating circumstances here, but, I'm not one to deviate from the terms of the plan. I think in this case, the member's spouse made some request for payment more than 90 days ahead, so I don't think that's a problem.
I believe that to be the case, Bob. So just, my motion would be to have an official board action that the 90 days does not apply since she inquired prior to 90 days.
Yes, in this particular, that I think would be in order in determining the facts of this case. The board's making a finding that the 90-day rule is not applicable.
So moved.
All in favor?
Aye.
The only other issue that I wanted to talk about is I did receive an inquiry from the chair asking a number of questions about rights of members who have a dissolution of marriage. And the questions are asked involved the member's annuity, it involved returns of contributions, it involved what happens if I drop, what happens if I backdrop. And it occurred to me that it would be useful if we had guidance on this. And I had actually started working on it in response to the chair's request, that just about completed a memorandum which we would be able to use as a tool to just give to members and say, listen, if you're getting a divorce, give this to your lawyer. So, because I get a lot of questions, and unfortunately, we've had staff members in other cities that get subpoenaed for depositions, or they have to go to court for, contested divorces to tell the same story over and over again. Well, this is what the plan says, and this is what the rights of the member are. And no, we don't accept qualified domestic relations orders because we're not covered by the Federal Retirement Equity Act, and the list keeps going. So the board had not pre-approved the work, and I discussed it with William, and I believe I discussed it with Trustee Barbell, and I said, since you hadn't pre-approved it, if having done the work's an economic concern, we'd waive the fee. I do think it's a useful tool for you to have, and I'd really like to finish it one way or the other. So to that extent, if you're of an agreeable mind, just ratifying this assignment, because it started out as questions from the chair, and will provide a tool which can be used. Florida has very specific case determinations about divorce, which includes, as I said, how drop divides, how backdrop divides, how you determine the marital share, particularly when the member and the spouse, the term of the marriage was only coextensive with part of the member's career, or where the member gets a divorce but continues working, what happens to the growth of the benefit after the date of divorce, and by the way, what's the tax treatment of the benefit. So I think this is, we have done similar work for other funds with the particular nuances of their plan, and it's proven to eliminate staff involvement and mine in divorce cases, so it has turned out to be a cheaper exercise. And I think that bill is probably up on the screen.
Any board discussion?
Yeah, we have about, what do we have, $1,500 in it, and there's maybe another hour worth of work to do to finish it, so we're looking at $2,000. We'll just cap it at that. So if that's the case, then motion in order to ratify the project with a cap of $2,000.
So moved.
Any discussion?
Bob and I had a long discussion about this, and I was on,
Which, by the way, I didn't bill you for.
oh, no, I mean, I wanted to understand, you wanted to explain to me what the purpose of it was, because I'm not
Yes,
a
I
big
did.
fan of a board member directing the attorney to do work on behalf of the board until the board's discussed it. But he is gonna provide us with a document we can hand out. I think, I'm gonna second your motion. I mean, and I thought it was something completely different until Bob explained it to me.
Yeah, it's not a private opinion, it's a document.
And I can tell you, it will save more than that time from staff, because I get subpoenaed 2 or 3 times a year in divorce proceedings.
Do you think this document will prevent that?
No, because it only applies to this plan, and it's usually the general plan. I am a court-approved expert on the City of Gainesville's general employee pension plan, by the way. So, but if it keeps 1 or 2 of us from having to go, that's great.
All right, we have a motion and a second. All in favor? Any opposed? Passes.
Okay, that concludes my report. Is there anything else you need from me?
So,
Yeah, thank you, Bob.
Thank you, Roger.
If not, I'll excuse myself and take my leave, so.
And Bob, I do
Yeah.
have, I had a question from staff on my way over here. We have, and you know, the changing of annuity rules, once it started being distributed, are pretty strict. If a member,
Yeah, the statute says you can't change, you can change the human who could be your beneficiary, but you cannot change the form of retirement.
okay, so if a person is in the drop, so it hasn't technically been distributed, is that considered a payment that's been distributed? That's really the,
Yes, a drop, once you
Okay.
tap, it says in the statute, either your first check, electronic payment, or your first drop deposit.
that's what I thought, I just wanted to confirm. You won't be, thank you.
You are absolutely correct.
Thanks, Bob.
Okay,
Thank you.
all right, everybody,
Bye.
Goodbye.
bye-bye.
All right, we can move on to, do we have any business discussion items?
Yeah, their LSV is the first one.
Oh, okay, I see. All right, so we'll move on to the presentation by LSV. James?
Hello. Y'all hear me okay?
We can.
Good. Super. Nice to see you all, and thanks again for the opportunity. I actually have a couple of board meetings today, so it's the first time I've stuck a tie on my neck in a while. It'd be great to see you all, and I'm here to give you an update on the 2 value portfolios that we manage for the City of Gainesville Police Officers and Firefighters Retirement Plan. As I said, for those of you that were there earlier, we started with you 22 years ago in small cap. It's pretty hard to believe it's been that long, but in that time I was a father of a baby, and now I'm an empty nester. That's how long it's been. But we started with $9.5 million back in June 2001. Today, the small cap portfolio is $24.4 million. And over those years, we've been able to withdraw $22.6 million. So the power of compounding over a lengthy period of time is really quite significant. We're essentially the same firm you hired. As I mentioned, I've been here the entire time. Most of our team has been intact for this entire time frame. We have had a couple of changes in the last year I'm going to talk to you about, and we have some that are upcoming. We sent out a press release last Friday. I think in my 23-year career here at LSV, we've only done 3 or 4 press releases in our entire history, so it's pretty rare. So I'll talk a little bit about that. The firm remains still very stable, $92 billion in assets. Value equities is our only business. We've got about 320 clients around the globe. Value as a style, up until really the SVB financial crisis this year, had been doing quite well the last few years. So we'll address kind of what's been going on there. If you go to slide 3, a little bit of a change for our history here. We've been closed in our U.S. small cap strategy essentially since you hired us. And we decided to reopen our small cap value product at the end of fourth quarter last year. We also opened our mid and micro strategies in the U.S. Those products have been closed for a long time. The reason is we've seen, typical cash flows like we're about to show you in your own portfolios over the years where clients are still with us, but continue to be in a cash flow negative situation, pulling money, funding other asset classes, paying benefits, whatever it may be. And with the down markets recently and the valuations that we're seeing on the portfolios, we felt it was a very opportune time to reopen some of our products and try to bring in some new capital. So first time in over 20 years that our small cap strategy has been open, and we're hoping to see some traction there. So I'll talk to you first about small cap, then we'll talk about your large cap portfolio, which has also seen some pretty good growth over the years and allowed you to take some money from that portfolio as well. Real quickly on the organization, let's go to page 5 and look at our team. So I mentioned a couple of changes in personnel. We've been extremely stable over the years with virtually no turnover. We unfortunately lost one of our colleagues earlier this year. Passed away in January. Tracy Bolgers, one of our operations managers that would have dealt with all of our cash flows from our clients. I worked with her for over 30 years. Very sad situation, but we have actually announced, we will be announcing very soon, we've got a replacement for her in our operations team. That hire actually is going to, the person starts actually this week. So we'll have that updated on the org chart next time. We were able to grab somebody from Northern Trust, who does a lot of our portfolio accounting work for us, outsourced portfolio accounting. And we identified a person that was on our team for a number of years that then moved on to another team. So that allowed us the opportunity to go over and steal that person for us locally here in Chicago. And then more recently, last Friday, we sent out a note about one of our academics who works on our team. And we were kind of right corner of the gray boxes here. You'll see a fellow by the name of Oscar Swami Nathan. We affectionately call him Swami internally. He's been our director of research for the last almost 18 years. And he told us very recently that he would like to go back and spend some time with his aging mother back in India. We weren't really expecting that to occur, but we certainly understand what he'd like to do. And so we worked out an arrangement with him where he will take a leave of absence in September, go see spend some time with his mother. And then at some point he'll return more than likely to the U.S., but more than likely as an academic. So Rob Vishny, one of our founders, did the same thing. I wrote that press release back in 2007. But Swami will come back and he will be on our payroll. So we'll be able to utilize him from at least the academic connections that he has. But he won't be a full-time employee of the firm at that point. So you'll see we have 3 other academic advisors that we work with. They've been helpful in generating ideas for us over the years. But the last decade or so, most of the enhancements we've been making to the process that we utilize, which I'll get into in a minute, have really been sort of by managing money. Accounting changes has been probably more significant than things coming out of academia in terms of helping us. And even though that was the foundation of our firm many years ago, most of our enhancements have come through accounting changes. And we have one of our professors, Dan Gaboli from Penn State. He's been very helpful in that regard. And we're actually looking to add some depth internally on a full-time basis with somebody with more of an accounting background. In fact, I had an interview yesterday, which was planned way before the announcement of Swami, was a candidate for that potential role. So things remain relatively stable. This is definitely a change, and but I think given we have a diversified, low turnover, model-based strategy, it shouldn't affect anything too much. Swami really wasn't touching portfolios; he was more on the research and innovating side. Joseph, our founder, no plans to change what he does, and some of you have met Jason Karczewski, who was a professor at Florida, that we brought into the firm about 14 years ago. Jason is the active firm as well. So that's the update on the organization. If there are any questions there, I'm happy to address those. If not, I'll keep going. Let's just jump forward really quick then to page 9. And this is our model that we utilize. And this is so we use the same effective model for both small cap and large cap value portfolio management. What we're trying to do is invest in companies that we think have too low a valuation. So some stocks get cheap valuations because they're value traps and maybe even in danger of going out of business. Others get there because sentiment in the stocks is poor. Maybe they stumbled in the past and investors have sort of given up on the idea. The objective of our model is that people believe that it's going to continue on, that there's going to be an extrapolation bias either on the growth side or on the value side. And that's why big companies like Microsoft trade almost 40. We wondered, well, why do all these cheap stocks end up down at the bottom? And in many cases, we think they don't deserve to be there. So our process is looking at the valuations of companies. We really want to try to identify healthy, cheap stocks, generating a lot of free cash that we don't think deserve to be so cheap. We want to buy a whole basket of them that we think have the potential to recover. So we have our most important block is the valuation block, the first one, and the value factors, where we're analyzing all the financial statements of companies and trying to find healthy, cheap stocks. The second component helps us identify those that have had poor past performance, and likely, therefore, the sentiment on these names is the reason they're out of favor more than anything else. They're not a cyclical stock at a peak. This is really a situation that we might want to be really interested in putting in a portfolio. So here we look for a period of 6 years, from 7 years ago to a year ago. We want to see the stocks underperform relative to other companies. So that's creating sort of this contrarian element that we take advantage of. And we leave out the most recent year because in the last 12 months, we want to see signs of recovery. So if you think about our entire 20-plus year history with the city of Gainesville, we have a situation right now where our portfolios are trading at some of the largest discounts we've ever seen relative to the benchmarks, which is another reason why we opened the strategy. But also one of the cheapest absolute valuations that we've ever seen in our history. So that combination, we've been waiting for this to pay off, and sort of around the time that we got a vaccine, we saw value stocks really start to recover. So late 2021, 2022, even into the beginnings of 2023, value was really leading the market, and you'll see that in the 3-year returns for your portfolios. And then something happened. SVB occurred, and there was a real panic in the market, and you saw this quarter value and growth spreads really gapping back out. Investors getting nervous, jumping back into so-called safe large stocks like Apple and Google and Meta and a lot of the big tech companies started doing much better. And we really saw a reversal of fortune in our portfolios, which I'll talk about. But it's frustrating to see because it feels like the opportunity that's presenting itself today is as good as we've seen in our entire history as a firm. So let's take a look at the performance of the markets on page 12. These numbers are updated through April. And if you look at the top section for large cap stocks, the spread between value and growth this year is just remarkable in the turnaround. So the first 4 months of the year, growth's outperformed value, at least at the index level, by 13%. That is a huge margin. Especially given that value had done so well last year and interest rates were rising, it really felt like we were on a path to pretty lengthy good recovery for value stocks, much like we saw coming out of the tech bubble, which we did very well post that period of extreme value growth spreads. You'll notice in mid cap, the spread was only 6.2%, and in small cap, it was about 8%. So not quite as bad as you go down the cap spectrum in terms of spread, but still big, but much larger in the large cap space, which is really remarkable to see. So now the 1-year return is slightly negative in large cap, quite negative the value growth spreads I'm talking about here over the trailing year, mid cap and small cap. But 3 years you see positive returns. very frustrating for us as a value manager and only business to see this kind of thing happen. What we do know is our portfolios have responded very well when value does well. There's a value button, we're capturing, and they've got multiple managers in the portfolio. Our job is to capture it when it's doing well, hopefully not get hurt too much when it's not doing. So, and our benchmarks are valued, so that's certainly helpful too. So on page 13, you'll see the history that I was talking about early on. We started in small cap with $9.5 million. Then it was full 22.6 million from the portfolio, and at the end of April, 24.4 million was portfolio value. Our long-term objective is to outperform by around 300 basis points. We had been doing that for quite some time, and then the last few years kind of hurt that effect, but we still have a nice premium long-term since inception, which we'll show you in a minute. But look at the spreads on page 14. So this takes a look at just using the MSCI as opposed to Russell, but it would be similar, where you're looking at the most expensive names versus the cheapest names, and what is the spread between the two. And you'll see that there was a bit of a recovery through the end of 22, where the blue line was rising, the red line was falling, spreads were kind of converging, and that was a period where we did extremely well. And then look what's happened sort of here at the end. You've seen that sort of gap back up the other way. Same thing has occurred in the large cap space. And again, that's been very frustrating because looking at a 20-year average here, growth stocks appear to be much more expensive relative to their history than value stocks appear to be cheap relative to their history. So that spread being very wide, generally that creates, when we've seen something like this in the past, a great opportunity for us. And the portfolio, as I said before, is not only trading at a good absolute valuation, but also the discount to the benchmark is very high. And in small cap, you'll see a significant portion of the benchmark we're competing against is in companies with negative earnings. So if you have quality elements in your process, as we do, we feel like in an environment where the economy is in a shaky mode, having high quality in your portfolio is something that's really helpful on a going forward basis. Again, the economic environment is definitely shaky at the moment. Let's look at the returns on page 16. So year to date, the portfolio is about even with the benchmark, down 3-1. But you can see the Russell 2000, our core small cap index, has done much better. We were outperforming pretty nicely through February in both portfolios. And then all of a sudden, the crisis with SVB, Signature Bank occurred, and the market sort of panicked on a lot of smaller banks and really anything interest sensitive, which we don't have a huge exposure in regional banks relative to the index. In fact, we're a little bit underweight in small cap. So it was really just a contagion that sort of affected value much more so than it was just a regional banking crisis. If you look at the one-year returns here, excellent outperformance compared to the benchmark, beating both benchmarks over the last year, even though value's lagging. The last year or so, the negative earnings companies haven't done very well. The first year of sort of this value recovery, the negative earnings companies actually did very well also. So we did okay, but so did the companies that we thought were fairly chunky. Our 3-year return looks pretty good, so we're seeing a nice recovery after seeing a pretty rough 2017, 2018, 2019, 3 years in a row. It's pretty rough for us. We had only one other stretch like that in the history of the team. Then we had a good bounce back, you can see, in 2021, certainly in 2022. So the long-term numbers still look pretty good. All these returns are net of fees. Since inception, 9.1 versus 7.6. And if you look at the sort of compounding return, it's pretty significant, 575% versus 395. That's where you were able to withdraw a fair amount of money, still have a nice cushion in terms of absolute excess returns. And that's been helpful for us over the long history. Now let's take a look at the next slide of valuations. So we have 205 stocks in the portfolio, very cheap. The portfolio is trading at a forecast for this year, forecasted earnings, expected earnings of just 8 times, and less than 8 times for next year. Significant discount to the benchmark. Price to cash flow at 5.6 versus 10.1, almost a 50% discount. It's one of the widest spreads we've ever seen. Pretty decent dividend yield on small cap names, and you can see the portfolio is pretty similar to the benchmark in terms of its market cap and stocks. very significant diverse benchmark. So we were looking at sort of all the sub-industries as well, which includes different kinds of insurance companies, money managers, brokerage firms, so all different kinds of organizations fall within sort of financials broadly. And we've got diversification in sort of all of those levels. So again, the banking crisis, we did not own any of those companies in our portfolio. In fact, they were too expensive, first of all. They actually had higher valuations than most of the names that we do own. But we have a couple signals in the model that really helped and prevented us from buying any of those. They had a fair, both those stocks failed initially, SVB and Signature Bank. Had a lot of short interest. Whoever the smart money is saw that these banks could be potentially in trouble, and they were shorting these banks heavily, much more so than other regional banks. And as we noticed that, that is a signal in our model that actually would have kept us from buying it anyway and lowered its expected return, so that we did not buy those companies. So the quality elements that are coming through in our portfolio really helped us in terms of being the right names. And that was certainly something that was good as we got into this year. But it's still, the contagion sort of to value did erode some of the excess returns we got, so now we do. If you look at our top 10 active holdings, which is in the lower right corner, you'll see a lot of the same names that you see in the top 10. So the benchmarks don't have high concentration in single names like you'll see in a large cap portfolio, which I think is one of the reasons why the spreads between value and growth in large cap are greater than they are in small cap, because it's was fewer names sort of driving that spread. But you'll see here just a couple of stocks actually that are even in the benchmark. So we don't necessarily care if the company's in the Russell 2000 value or not. If it's a small stock, we're going to rank it on our criteria for value. And if we like it, we're going to buy that company in the portfolio. But we're going to constrain how much we put in individual names. We're going to force diversification. We want to buy a lot of stocks. We want to sort of spend our risk budget on being very, very cheap. In the long run, we believe that's the source of excess return for client portfolios that we want to have in the portfolio, and it also is something that we think is more likely to occur. So buy a diversified portfolio across industries and sectors, and ensure that you have a good sort of even keel of performance. So you'll see a big difference when I show you the same slide for your large cap portfolio, where about half the names that are in our top 10 active weights are companies that we don't own that are big in the benchmark. And for us, too expensive. I have some attribution over the last year. So where did this 7% excess return come from? If you look at page 19, hopefully you can see this on the screen. I can't, but you can as well. And you'll see if you look at the sector exposures of the portfolio, the big driver, maybe an individual sector was we did quite well in industrials, consumer discretionary. We did well across a lot of the sectors. You don't see too many negatives, which is good. The best performing sector clearly was energy. We were underweight energy, which wasn't helpful, certainly, but it wasn't a huge component of the index and didn't have as much of an effect as it did in calendar 22. But you'll see a lot of the returns, very wide spreads, plus 10.7 in energy, down 23.8, communication services, financials down 13.8, pretty big spread. And with a year where you had a combination of good value months and good growth months, you'll see that our deeper value bias was actually not really hurting and not really helping. So it was kind of flat when you look at trailing earnings, which is EP. Also notice EP negative, which is that first line in the second set of variables. 20.7% of the index is in companies with negative earnings. So a fifth of the Russell 2000 value by weight is in companies that have negative earnings. If you look at forecasted earnings, 13.7% of the index is in companies that are forecasted to lose money. And we have clearly a big underweight in those names because there's really no quality there for us. That was something that did well, as I mentioned, in 21, but not in 22. And I think investors are, in this kind of environment, wanting to see companies that generate cash that are needed to survive any potential downturn in the economy. So, it's good to see that the excess return is being driven by stock selection in the portfolio. We're certainly pleased with that. Why don't we move on, just in the interest of time, to the large cap portfolio and sort of keep the discussion at sort of the portfolio level, and I'm certainly happy to take questions at the end. But if you go to page 22, you'll see our history with the large cap portfolio that started in August of 2003. And here again, the power of compounding. We started with 22 million, we've got about 27 today. Over the years, $42.6 million able to pull from the portfolio. So this is pretty characteristic of all of our clients, certainly their defined benefit plans. None of them are sort of growing in terms of cash flow in the asset class that we're in, so we understand that. But hopefully we can continue to add value where you can take those excess dollars and put them to work when you need it. This history is also quite good. If you look at the returns and spreads here too, you go to page 23. The spreads are very wide in large cap as well, between the most expensive and the cheapest names. And again, look what's happened at the end of the line. The spreads go back away as they were converging. We were doing very well. All of a sudden, this convergence has occurred again. And it seems like anytime investors get scared over whatever it is, there's just a flood into the top 5 names in the market, which are very, very concentrated, have very high valuations. If you're buying the S&P 500 today, you're really buying a growth portfolio, more than ever before. And therefore, it's important to balance that out. So if value does come back, value has a good year or two, you've got that exposure into the portfolio. That's our job. Let's take a look at the returns here on page 25. As I mentioned, it was a volatile start to the year. We were outperforming it by, I think, around almost 2% through the end of February. You can see the portfolio today is lagging by about 2% relative to the Russell 1000 value. So all of that we had gained really got pulled out. So the other thing that occurred with SVB and financial crisis wasn't just sort of the value growth spreads widening the other way, but also their investors moved into larger names. So small stocks really, really suffered from kind of that early period in March when that occurred. And that was the reason we had good excess returns in the large cap portfolio in particular. In the first couple months of the year was we have a smaller cap bias in the portfolio. The smaller names were doing well. The economy seemed to be doing okay, and I think investors were pretty confident in seeing buying these lower valuation companies. And that really kind of just spooked things. And we saw one of the more extreme reversals we've seen in a short time frame, really in our history. So if you look at the 3-year returns here again, decent excess returns, but it's been a very volatile period in large cap in particular. And there are some names in our benchmark today, to be honest with you, like Meta and Salesforce.com and Google, which in our opinion are not really very value. They're ending up in the value benchmark because of the size of some of the other big growth stocks. And Russell sort of being forced to put half the weight in value and half the weight in growth. If growth dominates like it has, more and more growth stocks end up in our benchmark on the value side, which creates an opportunity for us certainly long term if there's mean reversion, but those stocks are in the market, it's tough. Long-term returns you can see, and also the compounding effect. We're ahead of the benchmark. That compounding effect really means a lot over time in terms of dollars. These again are also net fees. On the next slide, you'll see the valuations for large. So small cap stocks were quite cheap. In fact, the large cap market is also very cheap, a little bit more expensive than small. But 146 stocks trading at less than 10 times expected earnings and around 9 times next year. That discount to the Russell 1000 value, again, very, very big. Surprising how large it's remaining for the last few years. The dividend yield is quite nice at 3%. You can see our cap bias here. So we don't have a cap bias in the small cap portfolio, but in the large cap portfolio we do. Because the larger the name, tend to find the larger the valuation, the more expensive the stock is. So the current environment sort of our model is really wanting to buy more mid and small names because that's where the diamonds in the rough appear to be from a model perspective. So we're definitely towards the smaller end of our history with Gainesville in terms of the market cap of the portfolio. But again, that's something we think should help us going forward as these stocks remain extremely attractive. And thinking about other things you can buy in the market, real estate, what's going on in the office market seems to be quite you'll see the sector weights here. Again, there is some regional bank exposure here too, but it's very, very small relative to the benchmark. And as I mentioned, you didn't know any of the names that went down, but the contagion was pretty broad, certainly within that sector and across other value markets too. Notice our top 10 holdings here. Our biggest position is in Exxon, but you don't see Exxon showing up in terms of our top 10 active weights. It's very different than the small cap portfolio. Exxon's also in our benchmark. And we've got a similar weight to the portfolio, or to the benchmark in Exxon. If you look at our exposure to energy, we're a little bit underweight. Still, we were underweight going into last year too. So we had a good year last year in both portfolios with underweights to energy. That was fortunate. So that means other value stocks also did quite well. But you'll see Berkshire Hathaway, we don't own. JP Morgan, we're not in. Underweight in Johnson & Johnson. So the top three sort of bets relative to the benchmark are in companies we don't like particularly. We have a decent overweight in Merck, and then there's Chevron. So of our top five, 4 of them are underweights. Pretty significant. You'll also notice at the bottom there we have Meta in the portfolio. Relatively new hire, that stock came way off its peak. As it showed some signs of momentum, we were able to get in. Valuations presented themselves were, and we needed exposure in that sector. That we could sort of invest and move some money in there. Is it the most attractive name? Certainly not. But it is attractive when you can think about its recent history and that sector, which is communication services. We've been a little bit underweight. And that's been a good one to have in the portfolio. 100% so far this year. Looking at attribution over the last year on the next slide. And it's the same information I showed you for small cap, and in this particular year, for this strategy, I'm also showing the market cap effect, which will be at the bottom. So first, from a sector standpoint, again, don't take big sector bets. You don't see a lot of attribution really ever coming from our sector exposures. That's not where we're trying to add value. It's really that deeper value bias that really takes the key to a long-term excess returns. So you'll notice here in the large cap space, much less exposure in negative earners, either on a forecasted basis or on a trailing basis. So more quality as you go up the cap spectrum, certainly. But our portfolios have big overweights in the cheapest stocks. So think of these, the numbers that you see here. What does it mean when this is greater than 10.9? That's an earnings yield. So we're invested in companies that are generating a lot of earnings relative to their price. And that earnings yield is very high. So we want to have a lot of exposure there. And in the last year, that was very negative. Cost us 1.4%. If you look at forecasted earnings, again, also cost us 1.4%. That's the next set of areas of EPF like one. So buying cheap companies based on the trailing, or buying cheap companies based on the forecast in the trailing year, much like you saw those spreads widening back out, it cost us. The other element at the bottom there is market cap. So we have that smaller cap bias and weight-based names. That's really the start. If you look at that, the last line there, companies greater than 30, almost 38 billion in size. We're underweight 22%. Look at the returns on the benchmark. That's the only segment of the market that had a positive return last year, about 3.3. The others, sort of 4 buckets, were down. So our value and our sidelines both affected performance in the last year in cost us. And at least you can see that the model's picking the right stocks in that area, but those biases were just out of favor over this period. There are a list of holdings you can see behind that, and our clients after that as well. Listening into your attorney call this morning, LSD does vote proxies for Gainesville. You're using a standard Glass Lewis policy, but because of some of the law changes in Florida and other states, Glass Lewis is investigating a potential new policy that would abide by all of those state laws. And that's something that we're working with them on. And we may need to convert your portfolio from their standard policy, which has certainly got the interest of shareholders in mind first. But I think even some of the state laws would consider those policies to be perhaps a little bit too liberal. So they're looking at creating another policy that essentially votes with management almost in every case. So that's something we're looking into and are keeping our eye on internally. it's almost up on 10 o'clock. I'm happy to take any questions you may have for LOB.
I don't think we have any questions, James. Thanks for the presentation.
Good. Super. Well, thank you all for your business. We certainly appreciate it. Thanks for giving me the opportunity to do this by Zoom. I would have loved to have been there in person. I've got another board meeting shortly after this with the city of St. Louis. So thanks so much for your business and thanks for your time this morning.
Thank you, James.
All right. Bye now.
All right, we'll move on to the presentation by Willis Thomas Watson. Cole.
Appreciate the time. I'm actually calling in from the great state of Florida, so good to be somewhat closer to you all.
It's all the sunshine in the background.
Yeah, kind of dark.
Recording stopped.
But yeah, we'll jump in. We have a pretty standard update from our part. Happy to share my screen. Wait unless you want to pull it up.
Yeah, share your screen, Cole. I'm having a computer problem.
Okay. We've all seen that.
I can.
Perfect. So, quick capital markets update. This is looking through the first quarter of the year. You can see up here in the top left-hand side of the screen, the equity markets returned 7.5% for the first 3 months of the year. It was actually really strong performance despite the volatility that we saw in the market with the collapse of a few different financial institutions. So continuing to see a ton of volatility in the market. But equity markets continuing to kind of plug along. 7.5 for the quarter is pretty good. Through yesterday, markets were up about 10% for the year. So we continue to see pretty steady performance from them, continuing beyond the end of March. And really what we've seen, and James kind of alluded to this, what we've seen so far this year is kind of an opposite of everything that happened last year. Growth is outperforming value now, or has been for the majority of the year. Yields have come down just a little bit, and equity markets have been really, really strong. So kind of a reversal of trends from last year. You can see in the right-hand side, positive 3% performance for fixed income markets. As I mentioned, since yields came down a little bit on the longer end of the curve, that helped them. The Fed has raised rates 4 times this year, and they're at a point now where they've indicated that they are going to pause future rate increases for the foreseeable future. And if you actually look at what's priced into the market, it's possible that they'll even lower rates at the end of the year, especially if financial conditions get pretty tight. So continuing to keep a close eye on that. And then I think the last thing I'd point out is down here in the bottom left-hand chart, the headline inflation number. You can see 1 year ago that was 8.5%, and the most recent print was at 5%. So inflation somewhat moderating, albeit this is above the Federal Reserve's 2% target, but certainly pretty far off the highs of 8.5%, even 9%. So having that subside somewhat is a little bit healthy for the economy. Any questions on capital markets throughout the first few months of the year? So looking at performance, this is also through March 31st. You can see here for the quarter, the total plan returned 4.5%, and the policy benchmark was 4.1%. So about 40 basis points of outperformance so far this year through 1 quarter. And if we look at fiscal year to date, so about halfway through the fiscal year, the plan is up 12.2% versus the policy benchmark of 10.3%. So, so strong performance for the quarter, for the fiscal year, and even if you go out further, for the 3-year number, Plan's up 12.5%, slightly above its benchmark. The 1 year was negative, but still ahead of the benchmark. So plan's performance has been really good kind of across the board. And if you go down to the large cap segment here, you can see LSV for the quarter just slightly underneath the benchmark, given all the reasons that James alluded to there. But their long-term performance is really strong, up 14% over the fiscal year, and even up 20% over the last 3 years. So just showing how well value has performed over the last 3 years is really strong there, 20%. You're complementing LSV with sustainable growth advisors, so a value manager and a growth manager. For the quarter, sustainable growth advisors returned 9.7%, which was behind the benchmark of 14.4%. So strong absolute performance, although they didn't quite keep up with the benchmark fully, but still pretty strong on an absolute perspective. And then longer term, over the 3 years, they're up 13.5%, a little bit behind the benchmark of about 18.5%. Same thing on the small cap segment. Pretty similar story. LSV for the quarter, pretty much flat. The market was down just a little bit, so they added some value there. Long term, performing really well over the last 1 year. They're down 4.5. The benchmark's down 13, so really protecting on the downside there, which is really kind of one of their main portfolio objectives. Disciplined growth investors performing really well. They had a good quarter, up 9.2 versus 6.1. Fiscal year to date, they're up 15 versus 10. And then even longer term, they're up almost 20 versus 13. So they called in at the last meeting, gave an update on their portfolio, but performance there continues to be really strong. And then rounding out the equity managers, Mower International Equity, they had a good quarter, up 7.5% versus 6.9%. Fiscal year to date, they're up 22.6%, so they're actually the best performing manager in the plan for the fiscal year so far. And then longer term performance, just slightly underneath the benchmark, but over the last 3 years, returning about 9%. So strong absolute performance from them. So then looking at the income segment, so this is 30% of the portfolio. You can see here positive performance across the board, even though the income segment benchmark has been negative. So returning about 1% for the quarter, benchmark's down about 0.5%. And then pretty similar story for fiscal year to date, returning about 1%. And then the benchmark's down about 1.5%. So adding some value, adding some alpha there. From the various managers. In the alt credit segment, you can see the segment as a whole returned 3.1% versus 2.7% for the quarter. Fiscal year to date up 4.7% versus 5.6%. So managers, I would say, are performing in line with expectations. We've seen yields kind of move around a little bit, and credit spreads move around a little bit. So various portfolios performing pretty well. Ares U.S. high yield 3.3 versus 3.7, so pretty much in line there. Fiscal year to date, a little bit behind, 5.6 versus 7.8, but still pretty strong performance given the macro market there. One Sharp continuing to kind of earn that 6% a year. This is the largest weight to the alternative credit segment. Pretty steady Eddie performance from them over the last 1 year, returning 6.3%. LibreMax had a really good quarter, up 4.7 versus 2.2. And then over the last 1 year, 4.7 versus the benchmark of 7.6. So good quarter. 1 year's a little bit behind, but performing in line. And then lastly, looking at Fallen Angel strategy, up 2.4 versus 3.6, and then up for the fiscal year almost 7% versus the benchmark of 8. So kind of keeping up with the benchmark there. And then the last piece of the portfolio, which historically has been the strongest piece of the portfolio in all the volatility that we saw last year, is the real estate segment. But so far this year, real estate has not been performing as well. Your portfolio in particular is actually performing better though. So you're up or you're down 1%, and the benchmark is down 3.5%. So getting some alpha there. The two Harrison Street funds somewhat protecting on the downside for the quarter, given the more diversified portfolios that they are. And principals even ahead of the benchmark, down 3.2 versus the benchmark down 3.5. But this is certainly an area of the market that is coming under a little bit of pressure, and I would say delayed from all the pressure that the rest of the market saw last year. The real estate segment, because it's not valued quite as frequently, you're starting to see some of that pressure kind of work its way into that piece of the portfolio now. But despite that, to be only down 1% in a market that is seeing a lot of pressure is pretty good. And you have a very diversified portfolio here. Office is certainly an area of the real estate market that is under the most pressure for pretty obvious reasons. And given your diversified nature with the Harrison Street funds, you don't have as much of an exposure to office as most investors do. So that's been helpful. But all in all, plan's performing well and in really good shape. So happy to answer any questions if there are any.
I have one. On the monitoring the ESG, will it change that the attorney recommends for our guidelines to be adequate to protect us? Or we need a separate monitor for that?
I think we'll be able to apply it to all of the asset classes. If there are specifics related to, credit or real estate, we can address those. I mean, the proxy voting won't apply to those, but there may be other rules or guidelines that we have to follow with respect, or other reporting that we have to do. So we'll just see how it develops.
It's going to take time to shake out.
Cole, are you guys seeing, or are you reacting to any similar sort of ESG restriction legislation in other states? I know that that's typically going to apply more to public pension plans than private sector, which is where you guys mainly operate, but do you have anything like this going on with other clients?
Yeah, there's public versus privates. You're still investing to make money, and so I think with the ESG concerns, you kind of have to walk a fine line there, because you don't want to invest in something for purely kind of social reasons. You want it always to be kind of pecuniary, financial reasons. But given that, we do have a lot of investors kind of talking about that, putting it in their investment policy statements to ensure that that plans operate in the best interest of their participants, and that comes down to making money and increasing funded status. And so, to some extent, in the 401k world, you're kind of seeing some different things for some various managers, but in the pension world, what we're seeing is that plan operators are really focusing on the pecuniary factors of investing, despite some of the kind of noise that's going on in the markets.
Any questions?
That's what you all have done historically as well. So,
Right.
Certainly not investing in any kind of specific names here that are targeting various social outcomes.
All right, thank you all.
Thank you all. Have a great Memorial Day weekend, and we'll see you next month.
Take care.
All right, next on the agenda, we already addressed the vested terminated member member benefit, so we'll move on to Form 1. You want to talk about that, Mike?
Sure. I think most of the board members are familiar with it. This is a form that's required for you to file every year. The State Commission on Ethics requires this from board members, and we try to remind board members to do it. I believe June 1st is the deadline, and you need to submit it to the local supervisor of elections office.
I think, well, you don't have a record as to who's current and who's not. I think I've submitted something.
We can probably try to check.
This year's already? Well, you were ahead of the curve.
Well, I think we got this.
Well, you do it every year. I know everyone got caught up, or I think everyone got caught up last year, but I'm not sure about this year.
Probably maybe 2 or 3 months ago, but maybe not.
You've already done yours for this year?
Yeah,
You're the man, Harvey. You're the man.
Well, I got your
You
latest
are
email.
on top of it.
And I just
Every
scanned it.
time a piece of paper comes across our desk, we manage it.
But the beauty is she always sends me a receipt.
I manage it. I put it in the pile with the rest of the papers.
It's triaging.
So anyway, we just wanted to provide that to the board members to remind
Thank you.
you.
It's only $25 a day after September 1st.
Wait for forward to that form.
It takes me about 10 or 15 minutes to do it. Most of it's copy and paste from mine.
All right, and last item of business is the RFP.
So we're just bringing this back to the board. It's been under discussion for a few meetings now. And I think at the last meeting, there were some questions about the evaluation criteria and the scoring. So right after the last meeting, I emailed the city's recommended guidelines for that, for professional services, just so that you would have a reference. Now, the board's not required to follow those procedures or recommendations. I think to staff, they make sense, but if the board wants to change any of those guidelines or the way you evaluate or score the RFPs, then you're certainly, welcome to do that. I think that was kind of the one thing that you wanted to discuss before we move forward and issue an RFP. But again, I'll leave it up to the board to decide, how they want to handle that and if and when they want to issue an RFP.
That's something that's internal, isn't it? Instead of going into the document itself.
We base the RFP on previous RFPs we've done that were sort of designed around the way the city's procurement department does RFPs. And then the guidelines or the handbook, they call it, for professional service evaluation, it's also an internal city document. I think it works pretty well. I think it makes sense. But, if the board wanted to make changes or have different evaluation or scoring, they could certainly do that.
As long as we don't do it based on ESG.
Don't use the term equity, we were close to what
The important thing, I think, is that at least when we do these types of processes at the city, is that you have to have the evaluation criteria in the scoring methodology determined and finalized before you issue the RFP.
So tell me, we have not yet decided firmly to go forward with the RFP, have we?
I haven't been told to issue the RFP, and so until I'm told to issue the RFP, you haven't decided to do so.
I mean, we just heard a pretty good presentation from Cole about the status of our plan in the midst of an uneven year. And I just don't see a reason to have to, unless you just want to test the water and see what's out there. It's a lot of work.
I think it's a certain amount of work, but it's not something we've done in this plan in over 20 years.
So,
And, you know, I think the recommendations typically for best practices is that you at least evaluate other service providers every 5 to 10 years. I think 5 years is probably too often, but every 10 years might make sense. And, you know, personally, I'm concerned about the fees we're paying to Willis Towers Watson.
That's my problem with it.
And I'm also concerned about their asset allocation recommendations with the alt credit. You're putting 15% of the portfolio into an asset class that's guaranteed to never give you your assumed rate of return. So, I mean, if you're comfortable with that as a board, then that's okay. As I'm not personally comfortable with that, but you know, that's really a board decision about the asset allocation.
So, William, haven't you sent us an RFP to review? And was that one that you crafted specifically for this? Okay, that's what I thought. I didn't review it right before this meeting, but.
We need to change the date. It's not-
I'm kidding.
I guess I look at the as sort of the income segment that they've done through this program that we have with them. And if we were in a different asset class, say in equities, and over the past, say, 3 to 5 years that we've implemented this program, whereby they just go out and select managers independent of the board, and then the board does do an approval, and then the board attorney has to negotiate an agreement with these firms. We fired probably a third of the firms that we hired over the past 3 years within this asset class. That's unheard of, in my opinion. You would, I mean, that shows a failure of this asset class. If you had to fire a third of your equity managers or your core fixed income managers or your real estate managers, you would say there's something wrong with this process or with the selection or the hiring of these managers if we have to fire a third. And then several more never even got hired because we couldn't even negotiate an acceptable agreement with them. So I just look at it from that point of view. But you know, it's a board decision. If the board would rather not do an RFP, then that's your call.
If fees are higher and there's no benchmark per se.
Right, the benchmarks are questionable. You know, I mean, they do the best they can, but they're not. I have issues with the number of the benchmarks. 3 month T-bills plus 1% is ridiculous to me.
For something that's.
And they're the upper echelon of WTW's group that we pay to get access to.
I mean, right now it
What
looks
would you
okay
do, 1
because-
year there, since their durations are less than a year on their loan portfolio?
Well, but even if you're looking at just the maturity range, a 3 month T-bill is a riskless asset.
Correct. Yeah, I get it.
And a 1% bump over that is not enough of a premium for risk. If it were 3 month T-bills plus 4% or 5%, I would say that makes sense. But 1% just doesn't make sense to me.
Well, if it drops some, you could have gotten 5% a month ago.
Well,
in
but we're sitting
6
on
months.
an inverted yield curve that we haven't seen in 30 years. So that's why that's the case.
We've been sitting on it for a while. Relative to past, Greg, I saw your.
So the other problem is, if you go ahead with it, went to a selection committee to bring back to the board, or how do you want to handle that part of it?
We just need a motion to move forward with the RFP that you've developed.
Yeah, I mean, if you think you'd like to do so, then we can issue it.
And if you get 20 responses, maybe we create a subcommittee. If we get 2 or 3,
Well, you two.
we might get 5. then maybe just the whole board looks at it, or we still create a subcommittee.
That's the other question, is how does the board want to structure the evaluation? Do you want staff to do an initial evaluation and bring you a short list? Or say if we have 5 or 6 or less, we just bring all of those to the board for you to evaluate? You can structure that however you want. You can do a subcommittee, but, I don't know if you feel like going through that process. That's sort of like a double evaluation.
If you don't like
Smaller
it,
group to shortlist it, if there's a lot of them, that doesn't bother me at all. As long as it doesn't include me.
Well, that's the thing. Who wants to be on the subcommittee, right?
Yeah,
I just don't have time.
I'll volunteer, Walter. I'll help him though.
It's not that I don't want to, it's I just simply don't.
I'm perplexed by the whole process because I don't think frankly, and I don't speak for myself, that I as a board member have sufficient gravitas to look at these, well, not having seen proposals, maybe it's a piece of cake. But I don't know that I would be able to give it the fair assessment that I think these proposals deserve. That's my own lay, perspective. Maybe I'm smarter than I think I probably am.
Well, I understand your point, and I wouldn't want to take any choices away from the board, but if you wanted to delegate staff to review, we don't mind doing that, but I don't know if all the board members feel that way.
Does the pension review committee, do they delegate any of it?
We do it. Because those agreements are with the city and the pension plan.
Right.
And the PRC is just,
Advisor.
they're an advisory committee, and they make recommendations to the board of trustees. So with all service providers, staff does the evaluations.
All right. The city has a procurement process and all that, that's fine and dandy. We don't have to follow this letter.
There are state guidelines that you do have to follow.
I'm not just going to put a bunch of names in a hat and draw it out. That's not what I'm saying. What I'm thinking about is shortlisting by staff and then board selection makes sense to me.
Yeah.
I concur.
And,
I mean,
with the short
you two
list,
aid
you
in that
bring the
pool
the
every day.
consultants in for a presentation, and they give a 30, 40-minute presentation, and they answer questions.
After your short list.
Where do you want to set the cutoff for the short list?
5 or 6, 3? You want 3?
3. I like
I'm at 3.
Top 3.
Is part of that, is it customary they always give you a list of who they represent, of contacting them?
Client
to
references.
see their feelings?
We certainly do that. We request it, and we certainly,
That's the level of work I was talking about.
Yeah.
I mean, that's not insignificant sometimes.
and remember, even if you go through the process, you can decide that, you're still happy with Melissa Johnson. It doesn't mandate that you have to make a change.
Okay.
Well,
Sure.
Make that motion.
For the staff to review
Yes,
and
and
come back
proceed.
with a
Change
list
the
of
dates.
3.
And to use the city
Go ahead.
professional services evaluation guidelines.
and that we were going forward with an RFP, which you preface it with that.
Okay, all in favor? Aye.
We'll get it started. We typically, these processes, we give them, a month to 6 weeks to respond. And then we take a couple of weeks to evaluate the short list. And then, so we're probably looking at coming back in September with some recommendations, because we don't have an August. No, yeah, September might work. Yeah, we don't have a July meeting.
It'll be no sooner than September.
Yeah.
I'm fine with that.
About the same.
You can carry it with October.
All right, is there any public comment or member comment? Not, then-
I Motion.
All right, motion to adjourn?
Second.
All right, so moved. Next meeting is June 21st.
Thank you, everyone.